Hey everyone, happy new decade. Welcome back to the channel. I wanted to kick off the new year by providing a quick update of my investment portfolio as a cautious 30-year-old in this current era of uncertainty and unlimited access to overwhelming amounts of information on the interwebs. We have the US presidential elections later this year. An Iranian general has been killed. Tesla is soaring. The S&P 500 rose about 30% in 2019, and the previous year, 2018, saw the S&P 500 drop about 6%. I'm really unsure what's going to happen this year in 2020, but with that, let's get right into it. I use personal capital to track my assets across my Fidelity 401k, my Vanguard Roth IRA, and my 2 taxable investment accounts. I'm still in the process of transferring a small American funds IRA over to Vanguard, and that comprises about $2,000. Anyway, here's my current holdings allocation view, and that's simply found by clicking investing and then allocation. I'll be blocking off some info on the left to protect my identity. You can see that I can keep drilling into my holdings here. If I just wanted to give you a quick example, the large cap blend includes some individual stocks as well as some mutual funds here, and you can kind of see all the descriptions of those as we scroll down. Maybe you noticed I clearly have too much cash still sitting in my money market fund at Vanguard, but I do have a plan to address this issue. This is VMFXX. Here's a asset summary of my total investment portfolio as of today, January 12, 2020. I track my investment portfolio with personal capital, but I use the Mint app and Excel for everything else to track my monthly budget and to track my overall net worth. I updated my Fidelity 401k. Current balance is close to $30,000 now. 2020 contributions have been increased to $19,500 max, and I've dialed up my S&P 500 allocation to 65%, up from 60%. I reduced my bonds from 40% to 35%. I don't think I'll be adjusting my future retirement contributions for a long time. I can expect an average annualized return of 8 to 9% over many decades per Vanguard's study. I will be linking that in the description below. I switched my Vanguard Roth IRA fund to Vanguard's Wellington fund. It has maintained an asset allocation of about 65% stocks and 35% bonds since inception July 1st, 1929, which makes VWELX Vanguard's oldest mutual fund and the nation's oldest balanced fund. The Wellington fund has 65% large cap value with about 10% international exposure, and the rest are allocated to bonds. And it makes it a balanced fund because it maintains that 65-35 ratio without me having to do anything. So there's no rebalancing involved. The Vanguard portfolio managers handle all of that. Through my research, the Wellington fund has performed similarly to the market, but with 40% less drawdown in the most recent global financial crisis from November 2007 to 2009 February, while the S&P 500 and the US stock market dropped about 50%, the Wellington fund instead dropped around 30%. I find that very interesting, and I'm all for cushioning any major blow to my portfolio, which is why I've settled on VWELX, Vanguard's Wellington fund. At 30 years old with a time horizon about 7 to 8 years when I'll actually need some cash to build a house. I know I'm missing out on potential returns by having this much cash immediately available now. So to address this issue, I have bought $5,000 worth of Vanguard's Dividend Growth Fund, VDIGX. And it's a mutual fund that's focused on high quality companies that will continually grow their earnings as well as increase their dividends over time. And so there's a mix of capital appreciation as well as dividend growth. The yield is under 2%, which is ideal for my taxable account. And through my research, it's produced similar returns to the market, just like the Vanguard Wellington fund. But in this case, when the market tanked 50% from November 2007 to February 2009, the Vanguard Dividend Growth Fund dropped 20% less. And that goes for the past 2 recessions, which is just awesome. So I'm still sitting on about $37,000 cash, as I'd mentioned before, but my plan is to deploy in increments throughout the year, and I've kind of just stuck to, investing $10,000 per quarter for 2020. And that could also look like $5,000 every 1.5 months. I did a little bit of tweaking in my M1 Finance taxable account. I now track 20 US companies, and I'm still adding to my position in VIGI, which is Vanguard's International Dividend Appreciation Fund. It's much easier to keep up with a smaller number of companies from various sectors. In future videos, I will go into detail on why I prefer M1 Finance for a smaller portion of what I call my play money, where I take on a more active role by picking stocks after trying my best to value them. So again, my M1 Finance taxable account, 20 US stock holdings are exposed to 10 different GICS sectors, with at least one company from each sector, and I'm continuing to equal weight them. When you first log on to your M1 Finance account, you're taken to the main dashboard. The platform has a very nice pie infrastructure, as well as this display of different periods of time. The pies include slices, and you can keep drilling into them. While you auto-invest, you can also invest fractional shares, so you have full control of exact dollar amounts. Here are my 20 US stock holdings. I'll share a link to my pie in the description below of this video. And in future videos, I will describe how I valued my stocks. I kind of keep this a smaller portion of my play money, and I auto-invest about $200 per week. Here's my international stock portfolio. Really just one fund called VIGI, Vanguard's International Dividend Appreciation ETF. If I click on activity here, I can sort by dividends only. I know that's what a lot of people are interested in, and I'm constantly being paid throughout each month, so as I add more money, this will continue to grow. Just always remember to do your own research. Focus on dividend growth. Don't chase high yield stock, dividends, unless you are ready to underperform the market, as well as, maybe you need that current income if you're retiring early. But really you want to focus on total growth, which is price appreciation, as well as the growing dividend. Here in the holdings tab, you can see at the bottom right the simple money weighted return. And again, I've done a lot of tweaking in this portfolio. I treat it as my play money, and haven't seen the best returns, but I really hope to move forward and continue building this portfolio. I kind of funded it with a lot of money at first, and then I took out a lot of money, so just kind of threw off all my numbers here. Anyway, that is M1 Finance, and look out for future videos on specifically focusing on M1 Finance. I've been practicing yoga for over a decade, and before every yoga session, we set intentions for ourselves which help us stay mindful and present. So to apply the same philosophy at a time when the markets seem fragile, ominous, uncertain, volatile, my intentions are as follows. I will continue to max my retirement accounts. I will continue to contribute to my taxable accounts. And I am vowing to deploy at least $30,000 of my existing investable cash by the end of 2020. So with that, I really hope you enjoyed today's episode from a cautious point of view in the vast ocean of dollars exchanging hands in the market. What are your investing intentions for 2020? And don't forget to please stomp that thumbs up button and click subscribe for more videos on personal finance and investing. Feel free to comment below or email me at themindofchase@gmail.com with any questions you may have. Good luck and happy investing, everyone. Thank you.